So, welcome to chapter 10. We spent the first uh, chapters figuring out our B word budget, how to get our income, how understanding what our income would be, what our taxes would be. Then we spent the next few chapters figuring out how to buy things, buy them on credit, get loans, buy a car, buy a house, and what that entails. Now, this next group is dealing with how to insure those things that we've bought, and ensuring what I call your assets. Because as we buy things, we need to make sure we have insurance to replace them, unless you want to self insure, which we'll touch on that lightly. But that it also, not only are we going to do property and motor vehicle insurance, but you are an asset. So we'll get into life and health insurance and disability insurance and those kind of things too, because you are the breadwinner. And or if you're not, somebody is, but yeah, but you've got that income coming in and you want to make sure you continue that. So that's what this next group of slides are on. And today we are doing property and motor vehicle insurance. So we've bought our car, we've bought our house, or we're renting. We'll get into both kinds of insurance for that. And we want to be sure that we have things. So looking at insurance is basically developing a risk management plan. Um, there is a course at the university on risk management. You may or may not have taken it. But basically, what you're trying to do with risk management is you're trying to reduce your risks, i.e., by avoidance, et cetera. You know, if you have a wild and crazy lifestyle, toning that down. If you drive really fast, maybe slowing that down. Um, if you eat only pizzas and you're doing life insurance, maybe you should add a salad once in a while. But anyway, so it's developing a risk management plan to try to reduce the risk. It's also developing a risk management plan to try to figure out how to um, pay for the risk. Should there be a car wreck? Should there be a health insurance incident? Should there be a theft at your house or a tree goes through the roof? How do you have the money to pay for that? Now, some people will choose to self insure because they hate insurance companies. I understand it. I've worked in the insurance business for a long time. You know, it's got a reputation and part of it is well earned. But all that to say that it is important to have, to me, because I'm also in the insurance field, I feel like it's important to have insurance to cover those things. You're looking at a fixed monthly premium to cover losses, to cover accidents, to cover somebody else suing you, to cover those things. So that helps you not have to have tons in savings or tons in the stock market and having to be sure you don't need that before you've saved enough money to reimburse for having a car wreck, for having somebody sue you, those kind of things. Because a lot of those things you don't plan. You don't get up in the morning and think, "Oh, I think today would be a good day to have a car wreck." It's usually an accident. They're called an accident for a reason. They weren't planned. So because of that, it can be kind of difficult for us to self-insure because when the money's due, the money's due. And so you'd either have to get a loan to pay for it, et cetera. Or if you have insurance, you file an insurance claim and that takes care of it. So what is insurance? So let's get that covered. Insurance is protection against any kind of financial loss, small, medium, large, and it gives you hopefully peace of mind by having that. You want to make sure that you have everything covered that you need to have covered. You want to make sure that you're getting the best price that you can get, but you also want to make sure that if there is a loss, you've got someone to come in and take care of that for you, so you're not having to worry about that every little detail. The insurance company or the insurer is that the risk sharing firm. So they're taking part of the responsibility. Why only part? Well, technically, they're taking all of the responsibility, but you're contributing to that by premiums. So it's a split venture. You're paying the premiums, they're providing the protection. So it's considered a joint project when you do that. When you purchase a policy, you're assuming that you're going to have to pay a fee. You understand that, and that's what it is, and that's called a premium. And sometimes premiums are monthly, sometimes premiums are quarterly, sometimes they're annually, depending on the type of insurance that you have. Um, the insured is you. You're the person covered by the policy. So the insurer is the insurance company. The insured is you, and the policyholders who owns the policy. Typically, insured and policyholder are the same person, but they could not be. And so you have to be sure of that. Now, sometimes people will define insured as, say, your house or your car, and you're the policyholder. Still, you're the insured. So it's usually it's both of you. You are the person that's the insured and the policyholder. So, what are the types of risk you're trying to protect against? Well, risk is an uncertainty. It's not predictable, and you don't know how big the loss will be or how much things are going to cost. So, there's a lot of factors out there, to me, who likes to have things fit on a spreadsheet, um, that make me very nervous if I were trying to self-insure. Again, some people do it, and that's fine. That's their choice. But it would make me very nervous because of the uncertainty. You insure against perils. Perils are the cause of a probable loss, such as a fire. The risk is that you'll have a fire. The peril is you had a fire, or a windstorm, or an explosion, or a robbery, or an accident, or in life insurance, a premature death. A hazard. They're going to list a hazard in your policy too. What's a hazard? Well, it increases the likelihood of a loss. Now, this is where we can come into play also with the insurance company to reduce some hazards. Defective house wiring, update it. A bush really close to the house, maybe it should be taken out. Or if it's a tree, look at trimming it, those kind of things. It was interesting. This is brush accumulated, which you don't want to stack a bunch of twigs by your house. There was a thing on Good Morning America that was talking about, and you know me, if it's talking about insurance, those kind of things, I'm zoned in. But they were talking about some of the fires and things that you could do as a homeowner to protect against fires in the places like California and Colorado and different places that have had some big fires. And one of the things they talked about, they looked at, of course, brick houses versus wood, which, we learned that back with the Three Little Pigs and the wolf, that houses of straw and wood weren't as sturdy as the one made of brick. Um, but they had a brick house, and then they looked at placing landscaping and or in this case brush or bushes further from the house and having a dead space of the bush to the house. Typically in Northwest Arkansas, especially, but in America, we put the landscaping right up next to the house. And most everybody does because a gap between your house and the brush or the bush, it makes a big difference because they said if the fire gets to that and is igniting, it's not then coming on as quickly to the house to then ignite the roof if it was going. Y'all can't see me. I've got my hands going all different directions to illustrate this. But if it's right against the house, you may have shutters that are wood. You may have, even if it's all brick, or the fascia board that of the roof is wood underneath that. And so if it's further away, it has less chance of catching the house on fire. And it exponentially changed it. So things like that, we can make a difference. Now, you may not want to be the only one in your neighborhood that plants your bushes 4 feet from the house, but just keep in mind that the distance that you can have between those things may make a difference in something like that. Again, trees are a huge thing. You always see, the ones on TV that the big tree fell and it took out two houses and a garage and a car. Um, those you don't necessarily want to cut them down because I am a tree lover, but make sure they're trimmed regularly. Make sure that you're keeping up with them to make sure they're not top heavy, side heavy, growing crooked because your roof line made them bow. There's things that you can do that can kind of keep up with it, and maybe top them every once in a while so that they're not as tall. Um, eh, that would go under house maintenance if you're, working on your budget. But it's just those things that we can do that we're kind of helping maybe reduce the hazard, which increases the likelihood of a loss, which increases the chance of a peril. And so if we do that, sometimes it can help bring our premiums down too, because they look at things like that. So what are a couple of types of risk? Well, one of them is pure risk. It's the most common. It means there's an insurable risk, there's a chance of a loss, but you're not looking to gain from it. It's for accidental, it's for unintentional risks. It's like weather and things like that. You can't plan those things out. And then nature and the financial cost of the loss can be predicted or have a number put to them. So they can look at the times that a tree of that size built that close to a house on the slope of a hill in Northwest Arkansas would fall. They'll have a calculation for that. I don't, but the actuaries do. So they can do that. Speculative risk is the other type of risk, and it basically means you could have a loss, you may have a gain. It kind of comes into when you think of gambling. Gambling is kind of a speculative risk. You hope you have a gain, then you hope you break even, and then you're just thankful when you walk away with a loss that it wasn't massive. That's kind of a speculative risk. And typically, a speculative risk is uninsurable because they can't define what that loss is going to be. So if they can't define it, they can't insure it. So when we talk about risk management, we've already mentioned a couple of these things, but what can we do? Well, one of the things is it's how to have your organized strategy to try to avoid to well, I just gave the first one away to try to avoid your risk. How are you going to manage your risk? Well, one of the things you can do is try to avoid it, which would mean don't get in a car and drive it. Don't buy a house with a tree. um, there's things out there that you technically could avoid. Then, of course, you can have risk reduction, like we talked about. Cut the tree down when it gets too big, or trim it. In a car, wear a seatbelt. Have smoke alarms in your house. For life insurance, you could eat a balanced diet and exercise. Don't have McDonald's every day. So there are things we can do to reduce the risk. Then there's risk assumption. Who's assuming the risk? If we self-insure, we're assuming the risk. And so we'd have to have funds available or loans or something to cover the loss. Because if something happens and your wall is knocked down, you got to be able to put that wall back up. So you got to have the cash available or a loan, et cetera, to do that. You could shift the risk, transfer it to the insurance company. That's what most of us do. And there's a deductible that they'll assign to us. So we're responsible for part of that loss. Kind of keeps us honest. So we have a deductible we have to pay, plus we've paid premiums. And so because of both of those, we're kind of shifting the risk. We're still taking part of some of it, but the insurance company is taking part of the rest. Examples of risks and risk management strategies. Okay, so you have a personal event, what the risks are, the possible strategies for reducing it, possible strategies for reducing the financial impact, and possible strategies for reducing the financial impact again. Possible strategies. So there's just three possible strategies there. Okay, disability, something we can't prepare. You can become disabled for short term, long term. You can become disabled at work from an accident. You can become disabled from a car wreck. You can become disabled uh, temporary, permanently, long term, etc. You can become disabled in your own home for tripping and falling. So basically, if you become disabled, depending on the extent of it, you may lose your income. So if you lose your income, you've lost that income stream coming in. And if you've had a budget or had to keep up with stuff, if you don't have money coming in, it's really hard to have money going out unless you've got a big savings account. So how do we offset that? Well, we can offset that with insurance. But we can also, if we're going to self-insure, we can also set it off by having savings, investments, have these accounts there. So if something happens to me, then they could draw from those to pay for my salary until I can get back on my feet. Disability insurance is the biggest one that would offset that. A lot of times, employers, depending on where you work, may buy a short-term disability policy on you. It's a group plan. You may not even know you have it, but what it promises is if you get hurt and you go out on disability, you still get your salary, but they aren't responsible for paying it. The insurance company is. So a lot of employers will look at that as a nice benefit. It works out well for you too because you're getting your payment, your salary still, but then they're not responsible for having to pay that. So that helps their budget with you not being in person and contributing to the workforce. They're not having to pay your salary. Um, so what's another one? Illness. We can't predict that. Heaven knows you can throw up in the middle of the night, don't know where it's come from or what's going on. So, by having an illness, depending on what it is, if it's short term, you probably don't notice it at work. If it's long term, if you have appendicitis attack, you may be out of work for a week or two. Kind of gets into that disability thing, but you may have to miss work. You may have to miss some things. You also will have expenses, hospital expenses, doctor's expenses, surgery expenses. And so, what are some things we could do to self insure that? Well, you can look at doing a healthier lifestyle. Now, I'm not going to try to be your parents or an ad here, but there is protocol out there. If you eat healthier, the chance of you having some issues that are health related are less. And we can't always predict those things, but that is the standard rule of thumb. But typically, what we also do in that process is buy health insurance. And hopefully, you work at a company where that's provided, or a good portion of it is provided, because it is very expensive, but it is very necessary. When you get hospital bills, a lot of times they used to show you, they may not now, but they would show you how much your bill, well, they still do, because on your explanation of benefits, or EOBs, they break it down how much they charged you for a procedure, what they discounted that procedure for, how much insurance paid for, and then what your responsibility is. There's like those columns across. And, a surgery procedure could be $20,000. They've already negotiated with the insurance company to write part of that off. So they write off, say, $2,000. Insurance pays for eight, then you're responsible for the rest. And out of 20,000, it's kind of like doing your taxes and reducing as you go down. Not having to pay 20,000 is a heck of a lot better when you can only pay 12,000. So, those things can really help in the process of trying to do that. And when we get into health insurance, we'll cover all the things that you can do with that. But anyway, that just kind of gives you a summary. And of course, death. It's pretty final. And so when you pass away, definitely your income stream stops. Definitely your they always say your income dies, your debts stay forever. So somebody's still responsible for paying off your credit card, paying off your car, paying off your home, or paying your rent to the end of the month, or whatever. Any other liabilities that you have out there, they're responsible to be paid. They don't die with you. So having life insurance is a way you can provide that strategy to take care of that. If you want to self-insure, then you need to make sure you have all the money to take care of that, either in savings or investments, to process that and do that. Property loss, of course, we talked about, cost of repair. Um, there can be a theft, there can be a tree fall on it, there can be a hole in your roof, there can be squirrels eating the attic. I mean, there's all kinds of things that can go on when you own a home. Same thing can happen in an apartment. You're not immune to there, for sure. Um, but anyway, you would have to keep enough cash aside to fix those things as they happen. Again, if we could predict when they happen, that's great. I've had a couple of friends through the years that, decided, I'm going to self insure because insurance companies are a ripoff and I don't want to do that. Fine. So, we set up a plan so that they could have enough set aside to repair a roof themselves, not, with a hammer nail themselves, but know what the cost would be, and, prepare for as many things as you could think of. And they were going to start this savings plan. They were going to stock it away. They were going to, triple it in the stock market. And that's the way they were going to go. Well, lo and behold, the first, they got about 3 months into that plan, and a tree fell on their house and took out the garage and part of the kitchen. So in that process, taking out those 2 things, they had a big hole in their house. So they had only saved for 3 months. It didn't matter. They had to get cash to pay for the garage to be repaired, the hole in the house to be repaired, the tree to be hauled off, and they were responsible for all of that. And so, needless to say, there were a lot of loans gotten at the bank to take care of that coverage. But by having that, then if you've got insurance, there's a deductible you have to pay out of pocket, but the rest of it the insurance company handles. So that's a real plus on that. Liability is another thing in property loss. That's a really hard thing to sue for. I mean, to sue for. That's a really hard thing to provide for, because what you're looking for there is claims, settlement costs, lawsuits, loss of personal assets, and loss of income. People can sue for all those things in liability. If you're at fault in a car wreck, or your tree fell on their house, or those kind of things, they're going to need their money right away. And you hope they don't sue, but if they do, boy, that get kind of expensive. So again, insurance helps with auto, with homeowners. All of those have some kind of coverage in there to cover liability and loss of your stuff, as well as neighbor stuff if your stuff is responsible, car wrecks, etc. So that can make a big difference in that. So how do we plan an insurance program? Because you could insure yourself to death if you're not careful. But figure out the goals, figure out what you need. If you buy a house, you're going to have homeowners insurance, because they won't loan it to you otherwise. If you buy a car and finance it, you're going to have auto insurance, because they won't cover it. And of course, I think it's the state of Arkansas, it's required too. So Both of those, your plan's already set for you to do those things because if you have those, you have to cover them. So that part's done. But also knowing that you can get the best deal out there, you can make sure they're covering. You have a good agent, someone when you call takes your call. You want to make sure that if you have a claim that they're there to help you and not just give you the number to file it online, which so many have gotten to now, which is fine as long as you've got good people online to help you with that, because inevitably there's a question, there's something that doesn't get paid, there's a question you have, there's a question they have, something happens and you need to talk to somebody. So you want to make sure they have good customer service. And then you want to be sure that you keep everything updated. If your house values triple, you want to make sure your coverage of your homeowner's insurance triples. If you've got a very expensive car that can only be repaired in Kansas City, um, well, it was Branson. We had a worker in our offices complex that bought a Tesla, and um, his car, the computer board went out, and then he was stuck, and they were trying to reboot the computer board when somebody didn't see him and ran to the back of him. So his car had to be towed to uh, Springfield, I think. To be there was That was the only body shop that could work on a Tesla. Then it had to be towed from Springfield to Kansas City because that's the only place that could work on the motor and the electrical equipment. So needless to say, he was out of a lot of money with that. But with insurance and it was still being under warranty, he didn't have to pay the cash. He was just out the time. But anyway, all that to say is, our best laid plans, we can't always plan when something happens. So that's the reason we can have a plan, but you want to make sure you've got it backed up to, if something happens before you have it all your money together, which is why insurance is good. And then of course put your plan into action. Budget what you need to pay, make sure you've got everything covered, make sure you've kept it up to date. And then use them to kind of make your risk management goals, especially if you've made a chart of what you want to be sure you cover. Make sure you've got insurance to cover those things or cash to cover those things so that you're well prepared. I would tell you to reevaluate your insurance periodically every 2 to 3 years. If you're with certain companies, they'll call you every year to do an evaluation. Um, you probably don't have a lot of changes in 1 to 2 years, probably not 3 years even. If you add a new car, you let them know immediately. On your homes, you may have bought a bunch of new stuff, but if so, you can let them know that. And then your life insurance may need some adjusting too, but I don't necessarily think it has to be done annually. It can be, so you can be sure you've got everything covered. But I would say at the most, at least look at it every couple of years. There's, of course, a circular chart. We like the circular chart, because so much of what we do in this class and with our financial stuff, it's never ending. It's not like, and that's hard for a person like me because I like to finish a project, put finished on it, file it in a drawer, and I'm done. I don't get that with a lot of financial stuff. It's a day to day to day to nobody here, anybody the day process. I mean, it's taxing, so it's never ending. But what you do first is set your goals, develop a plan, put your plan into action, and then check your results and update it as you need to. So it's a pretty easy thought there. Property and liability insurance, major disasters have caused catastrophic amounts to be lost. Hurricanes, fires, tornadoes, floods. When you think back to 2 years ago or last year or 2 years ago with the big fires in California, when they finally could get in there and look, I mean, it was just, and the one in Hawaii too. I can remember thinking, it was just, sometimes the baseboard floor plans of the houses, there was nothing there. So that means they've lost everything. They've lost structure. They've lost the all the furnishings. They've lost, it's just you cannot understand how catastrophic that really is. Clothes, shoes, and so most insurance policies have something for covering catastrophic losses. They also still call things an act of God. There's a lot of things that you cannot control, and that's the weather. Um, Fires, unless you set it, you can't control either. Um, Tornadoes, you can't control. So you have those things that are out of your control, of course, which is hard for me. That's the C word, is control in my word, because I want to have control of everything. But then you have issues that like insurance companies pull out of. states. Like a bunch pulled out of Florida when they had the hurricanes a few years ago, and there's just a few insurance companies you can choose from. That's not fair. That's not right. And then the same thing happened in California with the major fire. A bunch of insurance companies pulled out of that too. Well, that's the wrong time to pull out. People need you, and they need you there. So just keep in mind that but even if we have insurance, you may be doing some fighting to be sure that things get paid the way you want them to be paid. Um, of course, the one of the risks that you're trying to insure against for potential property losses. I mean, there's your property, of course, that you can understand that could be damaged by fire, wind, hail, water, smoke. Um, if it's property, you can have a temporary loss of use. If it's your car, if it's your house, you may not be able to live in your house for a while, your apartment, or drive your car, depending on what is going on. And there's the risk of loss of use. And part of the risk of loss of use too comes under play with like theft, vandalism. Sometimes they'll steal something or they'll, make a window so you can't live there because of the window being out or whatever. So that could be a big problem. Um, Liability protection is one of the big areas that people love to sue over. We've become a very litigious society. So you want to be sure because one of the things they can sue over is failure to take reasonable care. So probably the easiest explanation of this is say you have a pool and you don't have a fenced backyard and you let everybody in the neighborhood come play in your pool. Well, if something horrid should happen, you're responsible because you didn't take necessary precautions to prevent children in the pool, dogs in the pool, cars in the pool. So that's why you find most houses have a fenced backyard. They may have a fence around the pool if it's with a locked gate if they have young kids or something like that. You think why are they this is such a pain? But that's the reason they do it because they've shown that they've taken reasonable care to prevent accidents and be negligent. They're trying to prove that they are responsible. Um, Sometimes a person can be held responsible for unintentional actions or intentional actions. That's defined as strict liability. And so that's saying, well, you knew that there was a pool in the backyard, you should have done everything to take care of it. And you can say, well, I did, but it's still somebody still got through the fence or whatever. Well, then you didn't put the fence high enough. You didn't put the fence bars close enough. You didn't have a lock on the gate. There'll be something they'll find fault with. Vicarious liability is when you're held responsible for the actions of another person or of another pet or another house or something like that that you're not it's not your direct responsibility. Like you could be an employer responsible for an employee causing damage. Well, you didn't cause that damage as the employer, but you hired the person that was the employee that caused the damage. So they're looking for that direct loot to get to the big pockets. So that's where that can come in. Um, Parent held responsible for a child causing physical harm to another. Kids get into a fight at a school. If somebody breaks their nose, you may be held responsible. Well, it was my kid that broke the nose. He should be held responsible. No, you're the parent of that kid, and so there's a straight through to your pockets, which are deeper than your kids. Um, and then sometimes you can be held responsible for another person. You were all out drinking, and somebody got into a big bar fight. Well, you were with them. You could have stopped it, so you may have some liability there. So, it's those things. It's kind of hard to protect, but you want to be sure you've done the best you can. Okay. Homeowners insurance. We bought our home. What do we need to do? Well, we need to cover the house and other structures. You want to make sure you've covered your house, your garage. If it's attached, it's automatically covered. If it's detached, you need to make sure it's covered. Um, if you have a tool shed, make sure you cover that because that's probably got a lot of stuff in it. Plus, it's a separate building. Gazebos, trees, shrub, plants. If you look around your house or when you go home to your parents' house or whatever, if you look around at everything that's in the yard and the landscaping, like in our house, we've got two patios. The people that lived here before us had a greenhouse, so we've got a big we call it the slab, but it's got a drain and so we've got that we have some things on. We have plants on it right now, but then we have our patio that's attached to the house, and we've got part of it covered with one of those little gazebo rooms. But then we've got furniture. We've got 3 or 4 chairs, and we've got a picnic table, and we've got 4 chairs with that, and we've got a grill. I mean, there's a lot of stuff. And so if there's a big destruction or everything gets wiped away, We got to remember we have all that. So that's where a house and other structures come into play. You want to be sure you let your insurance company know all the things you have. Um, they will also usually come out and do a visual check and or an aerial check. A lot of counties and towns now have aerial maps that they post online, and by golly, they'll use them and they'll say, I've noticed this little building in the backyard. What is that? If you've got a shed, they're going to notice that you put it up. So just disclose it up front. Yeah, it'll probably cost a little more to cover it, but it's better than not having it covered and having a loss. But it's also better than lying to the insurance company too. So they always usually cover additional living expenses. So if you're having to, be out of your house for a period of time, that'll be on there. You may have to take out what they call a personal property floater, which sounds really funny. But if you have like high dollar jewelry or high dollar computers or high dollar TV, the limits in your policy, you want to look at those, may not cover replacing those items. And so if there's something that is of high value, you want to make sure you've got enough insurance to cover that. So you may need what they call a floater, and cover your jewelry or cover your TV or cover your sound system, those kind of things. There's a lot of money that's gone into a lot of things. And so the policies are pretty standard what they cover, and what you have may be over that. If it is, just add a floater and get that covered. You also want to make sure that you inventory your house. A lot of times they'll send you, pages online, or it used to be they sent out a notebook and they wanted you to take pictures and then of each room and then list all the things in each room. A lot of them are really good now with doing a video. So video each room, because if you have a total loss in your house, only thing left is the foundation, which we lived in South Louisiana, we lived in New Orleans, and we lived in South. We had a rental property in South Mississippi on the beach growing up, and we lost one house completely down to the slab, and we lost quite a bit in the other house with a hurricane that went through New Orleans. So you know when you the house to the slab, trust me, you go up to when they finally let you back in, and you go, all there is a sunken living room. So we had to sit down and figure out. We had dishes, we had pots and pans, and it was our vacation home. So it wasn't like we had everything, but we had clothes, we had shoes, we had beds, we had bedding, we had couches, we had chairs, we had bowls, we had pieces of pottery out, we had a TV. I mean, you start trying to think of all the things you have in that room. Now, if you're living there full time, you can exponentially apply that. So the best thing that they recommend, and I do too, is just take your cell phone and take a video slowly of everything in the room, so that you have not only a trigger to say, oh gosh, I forgot I have dishes in that cabinet, or I have all of my Waterford crystal in that cabinet. Because if it's closed, you may forget you have it. So just make sure you do that. And of course, you want to make sure you get the coffee pot and, all those things replaced too. So it just kind of helps you do that. If you just take a video of each room, and then a lot of times insurance companies will take that along with your recollection and writing of what's in each room to work on what they owe you if you lose the whole house. So home insurance coverage covers the house and structures. It covers your personal property, TVs, etc. It covers loss of dwelling. If you have to go live in a hotel for a period of time because your house was taken down to the studs, um, then they give you that. And so that is really nice and helpful. Um, and then also, it has liability coverage in case somebody's hurt at your house. And, the best of friends and the best of neighbors sometimes become enemies if someone gets hurt because they think they can see a dollar bill sign on that, so they might sue you. So that gives you some liability coverage for that too, and some way to pay their hospital bills through your homeowner's insurance without having to pay them yourself out of pocket. Household inventory contents, this just gives you an idea of what to be sure and check: basements, attics, rooms, and look for each piece of item that's in there. Like I said, because people stick stuff in the attics. It may be off-season clothes, it may be luggage, just stuff you don't think about. Bathroom, of course, has all kinds of stuff: shower curtains, towels, appliances. You may have everything you get ready with in there. Bedrooms, of course, have clocks, bookcases, dressers, clothes, shoes, I mean, all kinds of things. Curtains. I mean, you got curtains or blinds in every room. So just kind of knowing that helps you go through that. That's what that lets you know, to inventory all those contents. Most homeowner policies provide a basic personal liability of $100,000. And that's if that person wants to sue against you. You can also get what they call an umbrella policy, or sometimes it's called a personal catastrophe policy. And you can get up to $1 million in extra coverage. And that kind of is that gap coverage. If you're in a position of employment where people might think you have more money than you do, or you're in a position of uh, something where they just think they want to sue you for whatever reason if they get hurt, having that umbrella policy makes sure that you've got enough liability to cover the lawsuit, because very few lawsuits are going to be $100,000. They might be, but most are not. So you want to be sure you can do that. And paying for an umbrella policy is relatively inexpensive. So you can get a lot of coverage for a small amount of money. It's kind of worth doing if you're in that field, to be sure you've got enough coverage if there's that chance. Of course, we talked about there's medical payments and coverage that take out. You can also be sure that if you're on a floodplain, you will have to buy a separate policy for flood. And one of the things that they always try to figure out is, when did the flood happen? When we had the house in New Orleans and had the hurricane, we had water damage. Um, so they had to kind of figure out, did the water rise and it was flood damage before the windows were blown out, or were the windows blown out and that caused the water to get in and ruin the floors? That was what they determined. The windows were blown out, and then the floor was damaged. There may have been a little flood damage. We were back by a levee, but they determined that it was not we had our house built up a little, so they determined that was not the issue of the water on the floor first. It was the issue of the windows being blown out. So that can be a big difference in when they cover something, because they don't cover floods. Floods you have to buy a separate policy for. Earthquakes, you also have to buy a separate policy for. And trust me, every year when you have more and more earthquakes going on, I always go, okay, now we're not on a major fault, but we're by a couple of faults. Should I get earthquake insurance? I haven't yet, but the year we have a big one, I'll probably change this video to say that I now have it. Um, but if you live in a place close to, like in Arkansas, close to Jonesboro, where they have quite a few earthquakes, it might be something you want to think about doing. If you live near a fault, if you live near something where they have a bunch. So it's just something you have to know, that you purchase it separately. Or an earthquake, it can be added as an endorsement, but it's not covered automatically. Renter's insurance. I'm going to tell you, if you rent, you need to have renter's insurance, because it offers a lot of the perks of a homeowner's policy. Um, but of course, it doesn't cover the building, because that's not your responsibility. But it takes care of your a loss of your goods. I mean, and even if you're a student renting an apartment, you've got an accumulation of computers and iPads and readers and whatever. I mean, it's it's not like you live there with one pan and one bowl and one spoon. My husband did when he was in school, but most people don't. Um, so it would cost quite a bit to replace stuff. So again, it gives you that protection of loss of theft, vandalism, fire, etc. It also provides for additional living expenses. Apartment next to you catches on fire and you have smoke damage, you probably can't live there for a while till they get it all cleaned. Well, this your renter's insurance will provide that living expenses. It also gives you some personal liability if someone gets hurt in your apartment, or if you're renting a house, whatever you're renting. It gives you some liability coverage there. And of course, the building's owner, their insurance doesn't cover your stuff. You're just a renter. Now, their stuff will cover the four walls and the door coming to your place, but that's it. So anything beyond that is you're responsible for. So you want to be sure that you've got some protection there. Um, all of the policies include these perils. They call these things perils, which means they can happen: fire, lightning, windstorm, explosion, riot, civil commotion, aircraft, vehicles, discharge of water, freezing, accidental damage from steam or electrical current. So all those things that can happen are covered. Those are things that are covered in your policy: smoke, vandalism, theft, glass breakage, volcanic eruption. So far, that's covered. But of course, in Arkansas, that's not a huge risk. Falling objects. You hear the bizarre stories every once in a while. That thing just fell from the sky. Um, if an engine fell from the sky or a luggage from an airplane and it fell on your roof and comes through the ceiling, you're covered. So all those things to say, you're covered. Um, Homeowner insurance forms they have all these little rankings, and sometimes if you get an agent that's not well versed in explaining it to you in a way that all of us understand, they go, "Well, I think you need an HO3 and you might need an HO5." And you're going, "Okay, what does that mean?" Well, HO3 is all risk. HO4 is basically renter's insurance. And what the HO is homeowners. So homeowners 4 is is your renter's insurance. Homeowner 6 is if you have a condominium, because we talked about there's separate rules with that, because sometimes with a condominium you own the yard, so you'd be responsible for a bigger parameter than a renting. Um, a country home, i.e. a trailer, is homeowner 7. So, and then the homeowners 3, they have a homeowners 1 that just does the basics, and homeowners 2 that adds on a bunch of the liability. And so homeowners 3 is what most people get anymore because it covers everything. And especially if you're financing, well, if you're renting, it doesn't matter. But if you're financing your home, you've got to have what they call all risk coverage. So it's HO3. So while there are 7 categories, most of them fall into 3, 4, 5, 6, and 7. So um, this just explains each one of them and what they cover. Um, and what they don't cover. Again, they don't cover a flood, they don't cover an earthquake, they don't cover a war, which is kind of frustrating, and they don't cover nuclear accidents. And that's, of course, I guess they figure will be gone if it's a nuclear accident, so they don't really care. But that can be really frustrating if you live near Russellville where there's a nuclear reactor, if you live near a test site where they test things at an air base or something, because there might be some nuclear leaks. So if there are and you live there, check to make sure if there's some kind of coverage you could get for that. Homeowners, we talked about, covers against everything. Uh, Condominium, again, covers the belongings. Um, and you may own the walls and you may own part of the yard. So that's the reason condo insurance is a little different. And then the country home could be a trailer, but it could also just be a farm home, but it's going to have a little more coverage for land, because of the size of usually the land if it's considered a country home. And then they may have coverages that cover medical on your property, additional living expenses. They'll cover all that, but they may have higher limits if you're a working farm kind of thing. So how much coverage do you need? Always the bottom line question. Well, you want to be sure. Um, they're going to give you the option to replace things either in an actual cash value, which that just means I bought a couch in 2010. So if we had a fire and I lost the couch, they would take the 2010 price and depreciate it, um, to the current to what it would be worth today. Well, that's been 16 years ago. It's probably not worth much. But then that's the payment I get is on that. I would recommend you get replacement cost. Replacement cost gives you the full cost to replace that. So say I bought that couch in 2010, I have to go buy another big couch. The replacement cost is what it costs me to buy that today. So if you can afford it, it is a little more expensive to do that, but if you can afford it, it's a much better deal when you have a claim. Only because they don't depreciate the item. So that really helps. And they have a few limits in there, but you're fine. Of course, we talked about brick houses being better than than wood. You get discounts like you kind of do on your taxes where you can take things off. You get credits and discounts for certain things, not having an accident for so long, not having a claim. If you get older, they think you're wiser. Having brick, not wood, those kind of things can make a big difference. Also, deductibles. They'll have different levels of deductibles that you can choose. Usually, the higher the deductible, the cheaper the premium. But I would tell you, if you're going to raise your deductible, make sure you have that cash somewhere you can get at it. Because if you raise your deductible to $1,000 or to $5,000, when you have that loss, that's got to come out of your pocket first. And that can make a big difference when you're trying to work about a claim and get stuff finished. Is now I've got to take out, $5,000, but I got really cheap insurance. Um, so just know, I just recommend, if you're going to have a higher deductible, have that money set aside so you're ready to go when and if you should need it. You can get discounts. We talked about, like I kind of hinted to a minute ago, with like you did on your taxes. If you put in deadbolt locks, if you put in a numbered security system, if you have a smoke detector, if you have fire extinguishers, um, if you sometimes bundle your stuff, put your car and your house on the same policy, that can be cheaper. Non-smokers, a lot of times, are cheaper than smokers because they have less chance of a fire. Um, and then compare the costs, compare the coverage, but as I would tell you, compare the service. Ask around, see. You may have a buddy that sells it, so that gives you an edge because you know that you can call them and control the service and get good service. But if not, do some investigating. Find out, are they a good company? Do they pay on time? Um, do they handle claims professionally? Those kind of things you can find out. Now they do have, you can Google, of course, all that, but you have to be aware of, what you read online. But there, you can look at consumer reports. A lot of times they'll tell you stuff. There's best insurance company that rates insurance companies, so you can look at it online and see what their rating is. Are they strong financially? Have they had a lot of? They'll tell you if they've had a lot of claims against them, like lawsuits, etc. That's sometimes is a sign that they maybe don't pay well. Those kind of things that you can kind of figure out to get your best coverage. Okay, auto insurance. We've done homeowners. Let's do auto. Um, in Arkansas, it's a state law to have auto insurance, so there's not a whole lot of wiggle room. Now, you will find a lot of times people buy, get their tags renewed, have their insurance card, and they're taking care of it. Then they let their insurance lapse, and then they have a wreck, and then it's with you. And so there is coverage, which we'll get into in a second, for what they call uninsured or underinsured motorist. So there is some coverage you can provide for if that person doesn't have enough insurance to pay for the claim. Like I said, almost all states have laws now. Not every state, but almost all states. You have to prove it when you renew your tags and et cetera, do stuff. And it falls into two categories on auto insurance. There's property damage coverage, which covers your car and things you hit. And then there's bodily injury coverage that covers the people that are in your car or in the car that you hit. So um, those are how we'll break it down. Bodily injury covers medical payments. It covers uninsured or underinsured motorists, and then of course it covers your bodily injury. Property covers property, collisions, comprehensive. We just went over that, so you got that. You're good. You got that. Medical payments would be if healthcare of persons injured in your automobile, including yourself. It also covers if you're injured in another person's automobile or struck by an automobile. If you live on campus, you understand the struck by an automobile thing is kind of a high risk thing up there. But it also, and then their bodily injury coverage covers financial loss due to legal expenses, medical expenses, etc. So there's medical payments for actual out of pocket medical stuff, and then there's bodily injury, that is kind of a liability coverage that may be ambiguous, but gives them a payment so that they're taken care of. Underinsured or uninsured, they kind of added under and uninsured into the same protection because so many states require now that you have insurance. But so many times you'll find too, when you start getting insurance quotes and they're so expensive, you may take off uh, a coverage to reduce the cost. I drive an older car, and my insurance agent just recently said maybe we should, just put your car on um, just accident only, kind of thing, and blah blah blah. And I went, nope, 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 nope. I want to be sure if something happens because I'm still driving it and it's still running and it's still going and it's going to be the vehicle that's in something if I'm not careful. So I want to be sure everything's covered. But you do have choices, and people will drop coverage with that. And then when they drop coverage, if they have an accident, then they're considered underinsured because they don't have enough insurance to cover it. So that's where that comes into play. Some places are getting to no fault. insurance and just saying you have an accident, you both your companies pay, walk away from it. We're done. You find that in Northwest Arkansas in parking lots 95% of the time. They basically say, because everybody, well, I was following the lines and she cut across and or he cut across and I was going straight. Anyway, that they finally got to the point that if it's in a parking lot, it's considered no fault. And what that means is that you both are basically, to me, you both are basically at fault, but it's just up to you to file it with your insurance company. You're not going to pin this on somebody else. You both have to, if you want to get your car fixed, you have to file it or fix it and take care of it. Too, if you get one that's talking the biz, as they say, they may say, "Well, I got you 100, 350 coverage," and you'll go, "Okay, what does that mean?" Well, the first number is the limit that will be paid to one person on an accident. So if it's 100, that means it's $100,000. So if somebody's in your car and somebody gets hit and they have a claim, they'll pay up to $100,000 for that person. 300 means that that's how much that will be paid. That's the top limit that'll be paid to all persons in an accident. So if you have 8 people in your car and they all claim $100,000, it's that 300 is not going to cover it. 50 indicates the limit that they will pay for damage to property of others. So, say you hit a mailbox, they're only going to go up to $50,000. If you hit a street sign or you hit a lamp pole, they're only going to cover up to $50,000. So, sometimes people have 100, 300, 100. Sometimes they have 50, 150. So, it just depends on where you fall in that, but that's what they mean. The first number is always the limit that's paid to one person in an accident. The second number is the total limit that's paid to all people in the accident for bodily injury. And then the third number is the property damage, and it's the limit they'll be paid to the damage of properties for damage of property. So, what is property damage liability? Well, that's to another person's car. That would be damage, or street signs, or buildings, or hedges, or whatever it is you hit. That's property damage. Collision is when you're in an accident and collide with another automobile, regardless of who's at fault. And collision coverage, takes care of that. Is what that means is you've hit another vehicle, and they'll figure out who's going to pay depending on whatever. If you're not at fault, your insurer will try to will pay your stuff and then try to collect from the other insured party. So, say you're driving through an intersection, somebody T-bones you, that's considered collision. So, your company's going to pay to get everything fixed. Their company's going to pay to get everything fixed. And then we're talking about just the vehicle. And then your company will probably file a lawsuit against the other company or send them the bill to get paid. That's called subrogation. That's going against the other company to do that. So they want to be sure they get that coverage reimbursed because technically you weren't at fault, and so they don't want that to be. They don't want to be out the money for you. It'd be nice if you got the double money, but of course you don't. Comprehensive is another coverage they cover coverage they cover, and that has to do like fire, theft, vandalism, glass breakage, wind, hail, flood. All those things that applied with homeowners apply on auto also, and it just means anything that happens like that um, is taken care of. It's falls under comprehensive. Now, some things in your car, like some radios or stereo equipment or add-on aftermarkets or things like that, may not be covered without adding a package liability or something like that to it. So if you've got some special things like that, you might want to be sure that they are covered, because it's not necessarily covering everything on your car. So, example: a broken windshield costs 1,200 to replace, and you have a $500 deductible. Um, so, and the insurance company will pay 700. So you pay 500, company pays 700, windshield's fixed. I will tell you that that's kind of an outdated example because most insurance companies now offer free windshield, and I've got free in air quotes. You want to be sure if you use your insurance company's free windshield repair that it does not go against you as a claim. Because sometimes they'll say, oh, no, we'll fix that for $10 or $20 or we'll take care of it. But then the next time you call about something or you're looking to change insurance, they go, well, we noticed you just had a claim. We can't look at your insurance yet. And you're like, I didn't have a claim. What was that free windshield repair that they did? So you just want to be sure that you know where that falls. Um, They have wage loss insurance for automobile coverages, so in case you're out of work while you're rehabbing, that is an additional expense or maybe added on as a perk. So you want to be sure how that goes. A lot of them pay for towing and emergency road service. A lot of insurance policies have added, roadside repair or something like that because that really helps a lot of people. So you just want to be sure if you've got those things, how to use them. Unfortunately, I would love to tell you that vehicle insurance is cheap, but it's not. It's expensive, and of course, depending on the car you get and the newer the model and et cetera, it can be kind of expensive. Um, the premiums, like if you listen to the example that we did, and we were working on the budget. Um, Depending on where you live, can make a big difference because there may be a higher accident rate in certain places. There may be higher prices to get car repairs done. There could be less car repair places. There may just be a few in town. They may have more claims for bodily injury or more accidents, and they have more claims. So all those things can enter into what the insurance premiums are. So they're not straight across the board. You want to check everywhere you go. I mean, when you're living there, you don't have to check when you travel, just when you're living there to make sure you've got that place covered. And if you're choosing on where to live, not that getting cheaper auto insurance is going to make your decision, but if you are choosing some place to live and they have cheaper auto insurance, when you look at it, you go, okay, so that's a good place to live. Probably doesn't mean they have a lot of that wrecks, vandalism, etc., or their premiums would be higher. So that's good to know too. There are legal concerns. Every state has laws that require how much you should cover for liability. Um, Legal advisors and insurance advisors now recommend 100 to 300,000 uh, for liability coverage, just because court settlements are what they are, and most people can't afford to pay an expensive court settlement, so they're adding it on their auto insurance. Um, Policy limits, more than 10,000 for property damage is appropriate. 50 to 100 is usually suggested, so you can see the big difference there. If you don't want to pay the cheapest, but you can't afford the 100,000, look for something in between and see if that helps you. Because again, you've got to pay for it out of pocket if you don't have insurance coverage on it. The year, make, and model of your car is going to make a big difference. The theft rate, you all may not be old enough to remember, but a few years ago there was, I think it was the Kias. One of them, there was some glitch, and all of them had been manufactured in a certain couple of years, and you didn't have to have the key to start the car. There was some little, or you could tweak something and start the car. Anyway, there was some glitch in their system. So because of that car's insurance went up for that year because of the fact that unless you had the fix, then they came out with a fix that took out, that corrected it. But it was really interesting to watch how much the Kia insurance had been relatively low, which is why a lot of people had Kias, and then all of a sudden their premiums tripled, and then they dropped back down if you got the recommended fixes and secured it. So all those things can make a difference. I would recommend, when you're looking at buying a car, not only are you looking at the payment, what you can afford, call your insurance guy, or if you work online or whatever, and put in, I'm looking at a 2026 um, you know, Ford F-150, see what it costs. Then put in a 2025 Ford F-150. See what insurance is on that. Get your idea of what it's going to be, because it's not just the payment that you're worried about. It's also the insurance premiums, and you want to be sure you've got that covered. The age and sex we are makes a big difference too. Unfortunately, women get a cheaper rate than men for a lot of years. So, unfortunately, women get the rap of bad drivers. But um, teenage kids, the premiums are through the roof because they are unexperienced drivers. The older we get, the better we are. So it can make a big difference. In Arkansas, just looking at it, state average is $2,410 a year for annual premiums with full coverage. But then if you look at the cities, Springdale is 2,224, Fayetteville is 2,272, Little Rock is 2,500, Bentonville is 2,193, Combs, Arkansas is 2,310. But so you're like, okay, well, I didn't expect that. Same thing with Texas. You look at Texas, Their annual insurance company, I mean annual insurance rate for home for auto insurance. Sorry if I say the wrong thing, it would help. Is 23.46. Well, it's 24.10 here. So you think, okay, good, that's great. It's cheaper in Texas. But look at Houston. Houston is $2,534, so it's almost the state average. El Paso's 2,000. Dallas is 1,600, which you think there's a wreck every time I go through Dallas. So you think that would be higher, but it's not. So all those things make a difference. Also, to note, in Texas, insurers are prohibited from subdividing counties into rating territories. So it has to be the town, not the county, so they can't break stuff off. So that can make a difference too. So just check the states if you have a choice to do that. You can compare rates at netquote.com, Consumer Reports, or the state insurance department will let you know if there's claims against that company. Again, you can usually look that stuff up online too. And of course, if you want to get the best auto insurance to sound like your parents, establish and maintain a safe driving record, avoid accidents and traffic violations, um, install security devices, make sure your car has an alarm and use it, lock it. Um, and maybe increase your deductibles if you need some help there. If you're a non-smoker, it's a better deal for you too. And then maybe if you have a family of cars, insure them with the same company, and that you'll get a discount that way. So hopefully that gave you some insight into insurance, the costs, what the companies are doing, and how you can spread the risk and share the risk for things that you don't want to have disappear into the wild blue yonder and not have to ever repair them or replace them. So have a good rest of your day, and I will talk to you later.